So good afternoon again, everyone, and welcome to SN's COVID-19 Town Hall. We've been here with you since mid-May, and we're still here with you through the end of May, or I guess starting in March. And due to the increasing use of this webinar platform, it may take a few moments for the system to adjust to the influx of attendees that we have here this afternoon. And if you are on this call, please remember to use the call-in number provided at the time of registration, as we're just finding that this audio form is much more reliable than our computer audio. Here are all the wonderful faces of our presenters that have been with us since mid-March, and we do have a guest speaker online this afternoon that will be introduced to you in a few moments and later in this presentation. Just a few housekeeping items before we get started here. You can customize what you're seeing on the screen with the GoToWebinar screen viewer. So you can minimize the video that you see from our presenters and maximize the screen to view the handout. And just a reminder to submit your questions through the GoToWebinar questions pane and using the following buckets at the front end of your question to help our panelists better manage the influx of questions that we get weekly more efficiently. Those buckets are workforce, technology, regulatory, cash flow, human resources. And as I mentioned, the slide deck is available for download in the handout section of the GoToWebinar panel. And again, if you're experiencing audio issues, please use the dial-in option that coordinates with your registration rather than the computer audio today. And here's our weekly disclaimer that all the information presented today is based on what we know on May 26, 2020 at about 2 o'clock in the afternoon. And the famous line, this remains a fluid situation. Just a few next steps here. Our next town hall is Tuesday, June 9th. And we have decided to extend this town hall series. Starting in June, will be bi-weekly and on an as-needed basis. And as always, you can visit the COVID-19 section of our website for additional insight and information. And all of our previous town hall recordings are going to be up there on that page as well. And in the meantime, if you have specific questions that you need help with, or you need help navigating the COVID-19 situation, you can reach out to our panelists and experts on our contact page of the website. Here's our agenda today. We do have an introduction from Tom Moul, and then our updates will include regulatory, cash flow, and the also famous PPP, and workforce this afternoon. We will be joined by Valentina Madura from BDO for our anticipatory organization series, and we will have our COVID-19 roundtable the next 30, 60, 90 days, our Q&A portion, and future-ready COVID-19 compliance, how SN can help you. And with that, Tom, do you want to take over for me?
Certainly, there we go. It seems a little slow and jumping in here today, but we're ready to go. And thank you, everyone, for joining us once again. Hope everyone had a great Memorial Day weekend. Some good news, I think, coming out on the horizon. The stock market's up quite a bit today, and I think that's because we've had some good news over the weekend on some potential vaccines being developed and maybe ready for use, maybe even later this year. So some really good stuff going on here. But we keep moving forward with the things we talk about here each week. As Kaylee always says, it's a fluid situation, and I think the SBA certainly wanted to make sure we didn't run out of things to talk about this week by dropping the final interim rule on PPP forgiveness on us at about 11 o'clock Eastern Friday night. They have a strange sense of humor, I think, putting that on us on a holiday weekend, but our team's been hard at work all weekend making its way through those rules, and Chad's going to have a very detailed update for you on that again this week. And that's always maybe the top topic every week. As Kaylee said, we will be continuing our town halls into June, although we are going to scale back to bi-weekly. So our next session will be on June the 9th. However, if any significant new developments come into play, we will jump in and put additional sessions in as needed. We talked last week about the HEROES Act being passed by the House a week or two ago, and that may be dealt with here in early June. So that's certainly something we'll keep our eye on, and we will obviously continue to keep watching the developments as it relates to PPP. So as Kaylee said, we have a full 2 hours ahead of us today. We'll be doing our regulatory updates. We're very excited to have Valentina Medura, the Senior Managing Director of BDO Capital Advisors, with us today to talk about some things that Rick will go into a little bit more detail, but the hard trend of business transition and demographics and what that means. Will this pandemic accelerate some companies wanting to transition and sell? What does that mean to you if you're in the market to look for a target and buy, or even if you are on that other side and you're looking to transition out? So we really look forward to some really interesting comments there that we'll then roll into our roundtable and have some further discussion on. We will again try to get to as many questions and answers as we can, either on the screen as we go through the session today or live at the end if time allows, and certainly we'll be following up on those with you throughout the upcoming week. So again, keep your communication lines open to us. We know a lot of people are going to have questions on PPP forgiveness and other questions. Don't wait till next week to reach out to us. Come to us by the contact page at the website or email or call us at any time. Keep your eyes open also for other events that we will be scheduling. You can always see those at the event page of our website at www.stambaughness.com. When we do reconvene on June 9th, just as a heads up on that, we look forward. We don't have specific names yet, but we're going to have some folks from BDO's IT group joining us to talk about digital transformation and how that may impact your companies going forward as, again, we continue to move to more of a remote, more global workspace. So look for those invitations. You should be seeing them in your email for the June sessions coming up soon. So with that, I'm going to kick things off today by looking at the regulatory and tax items. There's not a whole lot of those this week, only a couple of things I wanted to mention before I hand it over to Chad. But one thing I did want to make sure we didn't lose sight of, it's still a little ways off, but we're almost here to the beginning of June, and that's that July 15th due date. Remember, all tax returns due between April 1st and July 15th have been extended to July 15th, but that date is coming up on us, somewhat quickly. Just some statistics that we saw in an article earlier today about tax filing to date. Through May 8th, there had been a 9.4% decline in the number of tax returns filed in this filing season as compared to last year. That's a difference from about 141.5 million returns filed to the same time last year to 128.2 million this year. And that certainly makes sense with the shutdown, with the difficulty of getting in front of your tax preparer and such. But we've also seen refunds have fallen off by about 14%. Not the actual average refund itself, but just the gross dollars paid out by the IRS. So if you're looking for a source of cash and you think you may be in a refund situation, you might want to start getting busy on that tax return and getting it filed. We have seen refunds be a little bit slower to be issued by the IRS, so they need a little bit more time on that. And as we've talked about in prior weeks, they're not really processing any paper returns and such. So you may have to adapt a little bit there. So don't let that July 15 date come upon you, sneak up on you too fast. Remember, the July 15 date is more than just the filing of the returns as well. It's giving you additional time to maybe fund an IRA for the year. An individual can put up to $6,000 a year in an IRA, or $7,000 if you're age 50 or older. Depending upon your adjusted gross income, you might even be able to get a tax deduction for that. So a good source of putting some cash away at a very tax-preferred method if you have that opportunity. Same thing would go for health savings accounts. Normally, you'd have to have those funded by April 15. But again, you have till July 15 this year to get them funded. That could be up to $3,500 for a single or $7,000 for a family plan. Remember, to be eligible for an HSA, you must be in a high deductible insurance program. But if you are, this is a great way to save for those out-of-pocket costs, again, in a very tax-preferred manner. If you're subject to a required minimum distribution, remember there was some suspension of that for the year, but don't get caught and forget about that. And one last point regarding returns. If you were one of the people that filed early, got your return in prior to the pandemic hitting or even during this time period, and now that some of the new tax provisions have come out and you're thinking, gee, I really would like to take advantage of those. There is a difference between what we would call superseded returns and amended returns. Amended returns stand alongside an originally filed return and are typically filed after the due date of the return. A superseded return just means you file another return for 2019 prior to that due date, and in essence will replace the return that you filed previously. Now, that's a fine line of difference, but what it can mean is by filing that superseded return, you would avoid any accuracy-related penalties if you did make some errors on your original return. So if you're not quite sure that the return that you filed previously is correct, you may want to talk to your tax preparer. You may want to look into the possibility of whether it makes sense to file a superseded return before July 15. And that's certainly something we can answer your questions about if you do have any. The other point I wanted to make was just a quick point on stimulus payments. I talk about stimulus payments often in these sessions. They continue to be paid out. As you know, as we've talked, they've gone out in waves. About 140 million people have received stimulus checks to date, totaling about $239 billion. The latest wave, about 4 million of these payments, are now going out via prepaid debit cards. So we want to make sure everyone's aware of that they don't think it's junk mail coming. It's actually a Visa card. And it's going out to folks who filed their tax returns or had their returns processed through the Austin, Texas, or Andover, Massachusetts processing center. Now, we know that at least what they state is in Austin, that's for folks who are residents of Florida, Louisiana, Mississippi, Oklahoma, and Texas. The Massachusetts processing center covers Maine, Maryland, Massachusetts, New Hampshire, and Vermont. I found that kind of odd that Maryland was in there. It seems to be kind of geographically out of whack with that. But the articles that I've read do kind of warn you that because of the kind of confusion with the IRS processing right now, and some service centers being open and others not, just because you are not in those states doesn't mean that your return may not have been funneled there, and you may actually receive the prepaid debit card if you haven't actually received your stimulus payment. So please, if you get that, it is valid. It's a card that has no fees attached to it. You can use it for online purchases. You can use it to get cash from an ATM, or you can transfer it to your personal bank account. So kind of a unique way there that the IRS is getting some money into our hands. So that's all I have on the regulatory front this week. I know you're all waiting to hear from Chad and to talk about the latest developments in PPP. So Chad, take it away. Chad, I believe you're muted.
Chad, you're on mute.
Hi, can you hear me now?
You're good.
Okay, thank you. I'd like to keep it interesting. It changed a little bit of what I had to do, so apologies for that. Like Tom said earlier, the Treasury and the SBA wanted to keep us out of trouble this weekend, so they gave us some light reading Friday afternoon, or Friday evening, maybe better say. And we did digest that to the best of our abilities here in the near term, so we're going to cover those updates in just a few minutes. But a couple other items that I wanted to mention. First, Katie, if you could just move to the next slide for just a couple of the updates. So since we last met, there was a new FAQ released. This was FAQ 48, and that's where we remain as of about 5 minutes ago on question 48. And this was related to the lender's completion of one of the SBA forms. So really no significant impact from this FAQ. And then there were 3 interim final rules since we last met. The first one was on May 20th, and this was a formal extension of time to return any funds from May 14th to May 18th. And this goes back to the question of need that had been talked about for quite a few weeks. They had one final extension, and this was the interim final rule that essentially formalized that last extension. One thing, there's really not a whole lot from that final rule. We're a week and a day past the 18th at this point. But one thing I did want to add is that the SBA also released a report that showed their loan usage for the PPP Phase 2 through the 23rd. And if you look at the report through May 16th, the prior week, you'll actually see that there was a decline of roughly $2 billion from the 16th to the 23rd. And I can only attribute that to some of the funds being returned, actually being more than the loans written this week. So there is still roughly 80% of the funding spoken for. So if you're on the fence and you're interested in the PPP loan, as I said last week, now's the time, because I don't know when or if there'll be additional funding, but there is currently funding available for the program. And we have some more certainty on quite a few items now than we did this time, say, last month. The second and third interim final rules are the one that I think are of much more interest. The loan forgiveness, we're going to cover in detail in just a few moments. And also there was an interim final rule on the loan review procedures that the SBA is going to undertake, and that provided some guidance on the borrower and lender responsibilities related to this program. So it wasn't 100% roadmap on what's going to happen, but it did provide a lot more details than we've known to date, and also clarified expectations on both the borrower and lender. So that's an important one to review as well, not to get lost in the loan forgiveness. So I hit on the round 2 usage already, talking about the 18th due date. And then not really a PPP related item, but I did also want to mention the Main Street Lending Program. And this is one that we've talked about for quite a few weeks. It seems to be inching into fruition. Here, a quote from the Boston Fed president said they expect to be making loans within the next 2 weeks on this program. This is a non-forgivable loan program, more equivalent to traditional lending, geared towards entities upwards of 10,000 employees. So it's for a much larger business. And they did remove the floor in terms of it used to have to be at least 500 employees. So really any company can take advantage of the Main Street Lending Program up to that cap of the employee base. So if you're looking for some additional sources of capital that might be favorable, the Main Street Lending Program is one that keep your eye on. Hopefully we're going to see some information soon on that. So we're going to move into the next slide and also into the forgiveness guidance. And I'm going to describe the guidance that was issued. It was 26 pages, mostly of what I'll call clarifications and a little bit of insight into the thought process from the authors. I really don't think there were anything that I would consider to be earth-shattering or groundbreaking this week in the guidance. But again, it's very positive to know and have a little more affirmation in terms of some of the positions that we're taking based on the application. So this was a 26-page document versus the 11-page application. And if I had to bet, I would guess that we're going to see at least some more FAQs on the topic to clarify some things that where there's a little bit of ambiguity remaining. And we'll hit on some of those throughout the process. But I wanted to start with the forgiveness process overall. They did expend a lot of the time in this document walking through this and how and what it's going to look like. They had given some highlights on this earlier, but went into much more detail. And this is for the forgiveness on loans that are not subject to SBA review. And what that means is not necessarily if there's a review for the need. If you remember earlier, we talked about lenders not having to look at the eligibility of need related to loans less than $2 million. That's the carve out around eligibility and the need. The SBA and the lender do still have the ability to look at the applications for forgiveness and the other documentations. And that, as you'll see later, is going to be a 6-year window that they're going to have the ability to ask for documentation related to that loan. So I don't want folks to mix those two items up. You're kind of got a buy on forgiveness with loans less than $2 million, or excuse me, with a buy on eligibility for loans less than $2 million, but your forgiveness is still subject to review at least by the lender and also potentially by the SBA. So hopefully that makes sense. The eligibility is the only item that was essentially carved out from review if you're under $2 million of your PPP loan. So what does this look like? You submit your application, and that's the form we looked at last week, the forgiveness application, and also the required supporting documents to the lender. There's really no clear due date on when that is due to the lender. The application form expires October 31st. So can we read into it that that's the due date for submitting that form? I'm not sure. And that's a question that again, we're hoping gets answered. If there is a due date earlier than the 31st, that the borrower must take action on so we don't miss that window. So after that form is submitted, the lender will review the application, make their decision, and then they issue that decision to the SBA, and that's supposed to happen within 60 days of the receipt of the form. The lender is also going to then request a payment from the SBA in conjunction with that decision so that they can be reimbursed for the funds that were lent. The SBA then remits the forgiveness amount to the lender within 90 days of receiving that decision. And an important note here is that the guidance this week noted that the SBA would remit both the loan amount and the interest that it accrued. So whereas last week we had said that the forgiveness seems to be capped at the PPP loan amount, now the SBA is going to remit the forgiveness plus the interest to the lender. So we're thinking we may be back where we were 2 weeks ago, interestingly enough, where the interest that was accrued is forgiven as well. But again, it really wasn't 100% clear, but it seems to me like a bank shouldn't be paid twice for the same interest. And then lastly, after the SBA communicates and funds the lender will then notify the borrower the forgiveness amount. So it's a little bit, goes up the ladder and then comes back down ultimately, and the borrower is informed of the forgiveness decision. And we're going to hit on a couple other items around the process that were clarified as well a little bit further on, but I think it's just for context, I think it's important to kind of keep in mind where we're at with the 6 steps that were outlined here. So now if we can go ahead and advance to the next slide, we're going to get into the forgiveness. We're going to finish up on the forgiveness process here. What happens if only a portion of the loan is forgiveness, or the request is denied in full due to a lack of eligibility? Any balance due on the loan must be repaid by the borrower on or before the 2-year maturity of the loan. So again, if we think about the timing of this, we have 60 days for the lender review, 90 days for the SBA, and then once the verdict is issued, there's a return of funds that are required. So that has to happen on or before the 2-year maturity of the loan. So what that looks like along the way, we don't know if there's going to be any kind of penalties for dragging that out or anything, but they just make it clear that it all has to be settled up within that 2-year window. So what if the borrower has already remitted payments to the lender? What if during this process we've returned some of the funds, realized we weren't going to utilize them, and maybe the paperwork for the forgiveness doesn't necessarily line up with the loan balance at this time? So what's going to happen is any of the excess, that the lender receives gets returned, gets paid back to the borrower, and everybody settles up on the back end. And again, this is probably going to be a pretty isolated instance, where you have payments and things already made and the settle up process doesn't true up, but they did provide some guidance on what that looks like should the 2 amounts not agree. And again, I think that really just allows you to know that you can still make payments and do things with the loan, and it won't be forgotten during the forgiveness process. They have a plan for handling those items. So if we move to the next slide, we're going to now talk about some of the payroll cost guidance. And it's more or less consistent with what was issued in the forgiveness application, but with a lot more insight and a couple of examples that were provided, which were helpful. With that said, it still doesn't completely answer all of our questions. You'll see here in a couple of minutes, we kind of have a conservative approach and maybe a more aggressive approach, depending on how your forgiveness results are trending. And, if you feel like you have a right to claim a larger portion of the forgiveness cost or payroll cost for your forgiveness. But it's really reinforced that the payroll costs paid or incurred during the 8 consecutive week, 56-day period are eligible for forgiveness. So that or was emphasized again in this guidance. And we really think that's something that there is some interpretation still. If what about wages that were worked before the beginning of this period, so they were incurred before but paid afterwards? The guidance really seemed to de-emphasize the incurred terminology, and it seems like it, with a read from this, that you can get reimbursed from the wages that are worked before but paid during. We're still not 100% sure if that was the intent of this guidance, is to open that window up, because that really extends the 56-day period, potentially, another 13, 14 days, depending on your payroll cycle. So that's where we have a little bit of pause, given just the inconsistent guidance, 56 days incurred and paid versus, are we able to get paid for those payroll costs that happened right before the loan funding and paid during the funding? Again, that's one of the points that we think that could be an aggressive read if you're looking to bump your forgiveness percentage. But again, I'm expecting further guidance on this. Where they did spend a lot of their time in this guidance that just came out was really reiterating the requirements around the last pay period. And this is on the back end of the 8-week forgiveness period. So again, they reiterated that if the payroll was incurred during the 8-week cover period, but paid on the next regular pay date, that was eligible. So they took away the need to have the payments made during the 8-week cover period, or the alternate cover period, which was the first pay period after the loan funding date, as an administrative convenience to those administering the loan, and also having to provide the documentation. This allows you to line up the documentation for the pay periods very neatly, and makes it easier without having to split pay periods. And then another item that was clarified in relation to payroll costs is if you have employees who are being paid but not performing work for the business, so they're working at home or actually staying home, and maybe you don't have any work for them that's suitable at home, how do we quantify and determine their costs? Are they automatically 40-hour-a-week employees? What does that look like for those individuals? And they clarified that in this situation, that the cost incurred would be based on the schedule that was established by the borrower, typically what that employee would have performed when they were actually working. So if they were a 20-hour-a-week part-time employee before the event, they will remain a 20-hour-a-week employee after. So that was a little bit of clarification that hadn't been in any of the guidance before in relation to those employees. So if we continue to the next slide, there's a couple other documents that we're going to hit on, and we're going to walk through an example here in just a minute as well, because I know there was a tremendous amount of questions on this incurred and paid and the alternate covered period items. But again, the interim final rule talks about an example that payroll costs paid during the alternate covered period are eligible for forgiveness. In addition, payroll costs incurred during the alternate covered period are eligible for forgiveness as long as they are paid on or before the first regular pay date. And again, that reinforces what we talked about last week, in addition to the timing and the payments. And again, they specifically come out and are making these affirmative statements that was kind of what we were reading into the guidance last week. And as I mentioned earlier, the alternative payroll cover period aligns the start of the loan date with the first day of the payroll after funding is received. But it's important to note that alternative payroll cover period is only available for pay cycles that are biweekly or more frequent. So if you're a semi-monthly or a monthly payroll provider, this is not available to you. So if you're weekly or biweekly, this is an option that's available to make it a little easier on the record-keeping side to make that election. So if we move to the next slide, I'm going to walk through an example similar to one that's contained in the guidance, but I added a couple other items here just to try to get us all on the same page. I'll let everybody be the judge of how we do with that. But again, the loan origination date in this case is April 16th. The cover period ends on June 11th. So we're a biweekly employer, and let's just say our first pay date and the 8-week cover period occurs on April 17th. So the day after we receive the loan funds. And then the first pay for wages incurred covered March 29th to April 11th. That first pay period on April 17th included no wages incurred during the covered period. And then you'll see we have the next 7 payrolls here as an example, and that covers the days worked up through July 4th, which is well after the 8-week covered period end date. And then I also have the payroll schedule down below. So if you look at payroll 1, again, March 29th to April 11th, the date paid is April 17th. It's not incurred in the covered period. It is paid in the covered period, and this is where we have the yes question mark based on, consistent with my earlier comments, that based on the guidance, it seems like this could be included and as an eligible payroll cost because it is paid during the covered period. Again, with all the emphasis on occurred previously, we're just pausing there. We just want folks to really look cautious, to be cautious with including that payroll until something more definitive comes out that says you can't do this. But as it seems right now, it appears that we can. We're asking folks to tread carefully with that one. Payroll 2 through 5, you'll see that most of those dates are in the covered period, and they're also all paid within the covered period except for payroll 5. And the reason why that's in there on June 12th is that's on the next regularly scheduled pay. And then also you look here at the pay from June 7th to June 20th. So we've got those last 4 days that are in that sub payroll during the covered period, and that's then paid on June 26th. So that's partially incurred. It is not paid in the covered period. But again, we believe that is eligible for forgiveness, at least to the extent of the 4 days worked up through the 11th. And then if you look at the payroll 7, the June 21st to July 4th, and paid on July 10th, none of those criteria are met. So that's clearly a payroll that is not eligible in any way, shape, or form for the covered period under the rules as they stand right now, which is 8 weeks. So this is an attempt to try to put some specific examples together based on what some folks may be experiencing with the biweekly pay period, and then show you some specifics on what this looks like under the dates and the criteria and the guidance. So we're going to skip ahead to the non-payroll costs for just a minute because I think it's helpful to compare and contrast these two. I know we're bouncing around a little bit here. But here's the same loan origination date, the same 8-week covered period end date, April 16th and June 11th, respectively. But in this case, we're going to look at the electric bill. And let's just say we have electric bills 1 through 4. The first bill was partially for service dates in the covered period. So you see that the incurred is partially. And that is, yes, it is in full forgiveness. The bill was paid during the covered period. The second bill, no questions at all. Everything occurred during the covered period. The third bill, the payment was made on July 10th, which was after the covered period. And how does that work? Well, what we're seeing is that you can seek forgiveness for the portion of that bill 3 for the service through June 11th, which is the end of the 8-week covered period. So in essence, you can get 2 and a little bit more of your non-payroll costs under the guidance that we're looking at today. Now, electric bill 4, the 29th to the 28th of July, paid in August. None of those dates are eligible. Now, let's just say with bill 3, let's just say we usually paid this bill on the 20th of the month, and all of a sudden we moved it up to the 10th. There is some question: are they going to allow the dates and somebody paying out of cycle? We talked about that last time. This was not contained in the interim final rule. So right now, even if you adjust your pay periods and maybe accelerate a little bit, there's nothing there prohibiting you from that. So it's just something to watch out for in regards to final additional guidance or FAQs that may come out. And one other example or comment on the non-payroll items is that interest is treated differently than all the other non-payroll costs. So rent, utilities, items like that. They do allow that advance payment on some of these items as long as it's paid in the covered period. But interest specifically says you cannot pay ahead on interest. So there's a specific prohibition on that in the guidance. So I just want to point that out, that this logic does not apply also to the interest expense. So if you want to go ahead and we're going to move forward and we're going to jump back into some of the payroll content after that brief break. And what we want to hit on here is, what about salaries, wages, commission to furloughed employees, or bonuses or hazard pay that were paid during the cover period? And we've talked for quite a few weeks that, we feel the bonuses were eligible, hazard pay was eligible, provided that it didn't annualize over to 100,000. And it took until this guidance for them really to come out and say definitively that, yes, these are all eligible costs as long as they're not over the 100,000 for the prorated period. So they do have that in writing now. There are some limitations related to owners that we'll cover in just a few minutes. But basically, they see these items as supplements to pays, salary or wages, and thus a form of compensation, just like anything else. Now, one comment is, how do these items then interrelate with the salaries and the hourly rate for the wage analysis? Did we pay at least 75% of our wages? And again, I think it's a little bit unclear on how that calculates into the rate. And this is an area where we could potentially be a little more, a little less aggressive, depending on where you're at with your forgiveness as well, is if you include those additional compensations in your hourly rate or your salary, or if you don't. It's not 100% clear in the guidance at this point how those factor in. And this is another area where it could be potential for a little more aggressive treatment if you feel it's appropriate. With that said, and with any of these positions, keep in mind that 6-year statute of limitations for review that I mentioned. And also ultimately, if the costs are disallowed, the fact that it does become then a 1% loan on the back end. So again, just wanted to clarify, some of the impacts of these items, some of the considerations around, the decision to be a little more aggressive or not. So we're going to move to the next item, which is retirement. And this is an item that is still of much debate, and it depends on really how you feel about the guidance on the payroll costs paid in the covered period being eligible regardless of when it was incurred. So, we've seen some positions now come out recently that they're saying that really any retirement costs that were paid during the period are eligible. But they're then limited to the FTE and wage reduction calculations. So if you laid off a significant amount of your workforce or reduced compensation, but you decided to use the PPP for the retirement costs, your forgiveness is really going to be ratcheted down because of the FTE and wage reductions anyway. Yes, retirement is an eligible payroll cost, but if you aren't also keeping your folks and paying them comparable amounts, your forgiveness takes a significant hit. So it's not a bad thing that, basically we've gotten cash to fund our retirement contribution at a 1% loan, but you won't necessarily achieve a significant change in your forgiveness unless you've retained your employees and paid comparable wages already, and then decided to pay some of these payroll costs, these retirement costs on top of those items. So I think it's important just to keep in mind the benefit of this may be capped based on some of the other limiters that are in the program. But if you've kept your employees, if you've paid consistent wages, and you're still short on the 75%, the retirement costs could be an avenue where we can accelerate some of those payments for 2019 that maybe haven't been funded yet, or even some of 2020s, and have that count as a little bit of a bump on our payroll costs to get over the 75% hurdle. Again, I think this is one area to be cautious with. I was kind of surprised that they had 26 pages of guidance, but didn't really take any time to specifically mention retirement at all. So again, we're applying some of the guidance to payroll costs, payroll, really, wages in general, to these retirement costs. But we're going to be to continue to be on the lookout for guidance that would really close the door on the option to fund 2019's retirement contribution. And again, the same concept is if you go this route, just keep in mind that they have 6 years to look at the loan, the documentation, and it may come back to morph into a loan to some extent down the road. We're going to move to the next item, which is related to owner's compensation, and they provided a little more clarity here, and also introduced some concepts that really had not been hit upon in any of the earlier guidance. So we have that cap on owner's compensation, which is the lesser of 8/52 of the 2019 compensation, or 15,385, or I'll add really the 2020 compensation for those that are not Schedule Cs. So they also mentioned that the employee's cash compensation is capped at the cash compensation and retirement and healthcare contributions made on their behalf for owner employees. And I'm interpreting that to mean Schedule C, Schedule C corporation tax returns and S corporation tax returns, as opposed to your Schedule C's and partners, because the guidance really elaborated on Schedule C's and partners, but really was mostly silent on the owner employees. So again, I just want to say that the capital 2019 is really for the C Corp, S Corps. So your Schedule C filers, they're capped at the owner's compensation based on 2019's net profit period. There's really no look to 2020. Schedule C's are going to get the 8/52 of the Schedule C profits from last year's tax return, and that's consistent with the guidance before. Where it gets interesting is general partners. And in some cases, these are very similar to Schedule C filers. But they introduced a new concept here, a little bit of a curveball, where the general partners is capped at the 2019 net earnings from self-employment on their K-1s, reduced by Section 179, unreimbursed partnership expenses, and depletion from oil and gas properties. So those are items that aren't in self-employment income on the K-1, multiplied by 0.9235. Well, what is the 0.9235? Well, that's essentially the employee portion of the wages that are subject to the employee self-employment tax. So they're taking out the 7.65% FICA that the employer would traditionally pay from this calculation. So they, to some extent, Schedule C's are treated a little more favorably. There is no such provision for Schedule C's that number needs to be multiplied by 0.9235. So it's kind of interesting to see how two items, two tax filings that are fairly consistent in many regards are treated a little different here. Also, we talked previously, there is no additional forgiveness provided for retirement or health insurance contributions for self-employed individuals, and that would be the Schedule C filers and general partners. The rationale there is that those items are paid out of the profits from the partnership or the Schedule C, which is really equivalent to the employee's contribution to health insurance and retirement in the C Corp and S Corp structures. So some of the guidance that came out, kind of helped us see a little bit further into the mindset of where they were going with some of the guidance in the application last week. Personally, I think our opinions are that, the health care and retirement benefits for C Corps and S Corps, that those are, business funded expenses, that we still feel that those are eligible. I could easily make a case that potentially they're not, but it's a little bit unclear, and we still think that there's enough ambiguity that those are eligible expenses for the S Corps and the C Corp owners. So we're going to move to the next slide. We're going to move away from, the payroll cost overall, and we're going to talk a little bit about some of the reductions and some of what we learned from this interim final rule. And the first one we're going to hit on is the FTE reduction exceptions. And if you recall, employees that were fired with cause, that voluntarily quit or voluntarily reduced their hours, they were able to be carved out from the FTE measurement, so that they did not negatively impact your forgiveness. But they did clarify with the interim final rule a couple steps to make sure that employers meet in regards to taking that exemption. And the first is that the borrower must inform the state unemployment insurance office of the employee's rejected offer of reemployment within 90 days of the rejection of the offer. And they noted that further clarification on this is going to be provided on the SBA's website. And I can only imagine that what's going to start to happen is that the unemployment insurance offices are going to start to cramp down on folks that were offered work and denied it. And what that may lead to for their unemployment compensation checks that they may be receiving. I'm not gonna guess what that might look like until they get around to tracking that down, if they're gonna be able to claw that back in any way, or what that might mean. I think potentially just knowing that notification is made may be a motivator for some folks to come back to their jobs. Also, the offer to return to work must be for the same salary, wages, and hours as before the separation. So if you're offered to bring a full-timer back in a temporary position, that will no longer get you the exception from the FTE headcount reduction. So So they must be for the same salary, wages, and hours as before the separation due to COVID. So those are two clarifications that came out in the interim final rule that I think are important to note. Also, I want to keep in mind that these offers and rejections should be in writing in some form. Emails, texts, letters, all those items I think are acceptable documentation. You just want to keep in mind that you need to keep them for the 6 years. So whatever you need to do to keep that documentation available and accessible for any potential reviews, I think is important. So we're going to skip over now to the second interim final rule, and this is more on the review procedures and what the SBA loan review may look like through this process. And the guidance is largely consistent with what came out before. It just mentioned that the scope of review can relate to a couple different things. And this is where I was trying to clarify earlier that the scope of review for eligibility we're assuming is only for those loans over $2 million. And that's based on the FAQ 46 and the safe harbor certification being met regarding need if your loan was under $2 million. So we think that the eligibility scope is somewhat limited, but the scope of the review also looks at the amount and use of the proceeds. Did you use the money in the right way? Did you use the right mix of funds? And all of those other considerations if they select the loan for review. And also the forgiveness amount. So they're going to look at the calculation for the forgiveness amount and make sure that they agree with the results. And again, there's that 6-year comment. This can be inspected for 6 years, and you're required to maintain that documentation. So if you're looking at some positions that may be aggressive, again, I think it's critically important on your application to document the positions that you're taking, why you've done it, and maintain that good documentation in your files. So we're going to move to the next slide. It's going to hit on a little bit more of the review process. And the borrowers do have an opportunity to respond to the SBA's question throughout the review process. So there is an opportunity to go back and forth and discuss the outcome. It's not a judge, jury, executioner type scenario. And even if the opportunity to respond doesn't lead to a favorable result, there's then an appeal process that there will be more details to come in a future interim final rule that you can take it to an independent body and have them hear your case. Again, we don't know what that looks like today, but it is something that's written into the guidance that there is, formal appeals. Also, the guidance in this interim final rule hit upon lender fees that were paid by the SBA and what might happen during the review if they determine that the lender failed to perform their obligations. And they did clarify that, the SBA's review, that those fees can be clawed back potentially. And I kind of say this as a preface to the next slide, which is talking about the lender's procedures. To keep that in mind as you listen to what the lender's obligated to do and result on the back end of these loans. So if we can go ahead and advance the slide to the next screen, you're going to see what the lender's procedures are related to these loans. And at a big picture, I will say that the lender's guidance or the lender's procedures should be fairly minimal. There's 4 bullets here that we'll hit upon in just a minute, but they're pretty easily met. They're not looking for a full-blown audit from the lender on these items. They're looking for the lender just to clarify that they're in the documentation and that the file is appropriate. So knowing that the lenders may be having to give up some of their fees, we're expecting that the review procedures from the lenders may not limit themselves to these procedures. So as you're going through this forgiveness process over the next few weeks, just keep that in mind. If you're getting scrutiny that you feel is above what the SBA and Treasury have outlined, that's a discussion point you should have with your contact about the level of that scrutiny to try to make sure that the scope is being really honored in regards to this. So just with that said, I'll jump into the details here. And again, the lender really just needs to maintain that they have a full set of documents, that the borrower accurately completed the calculation for the forgiveness on line 10 of the calculation form. If the payroll provider was a nationally known, recognizable third-party processor, so think ADP, think PayTimes, think of some of your larger payroll providers, meant to really be a very minimal review on the payroll calculations. Basically, they can accept the third-party payroll report as filed or as provided. And they did add that if the payroll provider was less recognizable, then a more extensive review may be done. They didn't get into the details on that, but essentially, if it was a recognizable name, they could take the report as filed. Clarify that ultimately it's the borrower's responsibility for the calculation of the loan forgiveness amount, and the borrower must attest to its accuracy. So last week we talked about some of the certifications required by the borrower on the application. And again, I think this just reinforces the need to closely review those certifications and make sure you're comfortable with what you're signing as a borrower requesting forgiveness. And then it also specifically states that the lender does not need to independently verify the borrower's reported information if the borrower submits documentation supporting its request for loan forgiveness and attests it's accurately verified the payments for eligible costs. So again, it's trying to make it very clear that the lender really does not have to subject this documentation to much beyond a cursory overview as I read it. But again, keep in mind their motivations and their incentives to keep the loan fees that they may have earned as they worked so hard over the last few weeks to get these loans processed for everyone. So that's just a little bit of context. So I'm going to wrap up. The next couple of things I have here, I just have some reminders on the next slide about the documents that are required to be submitted. These are the same as last week that we had discussed. And again, if you haven't already started calculating your FTEs for the base periods, I would encourage you to start doing that as well as gathering this information to start working through your modeling. And again, I would fully expect the lenders to maybe change some of these requests that you see here based on what their needs are and what their assessments are. And then the next slide is the list of the forms that are required to accompany the request for forgiveness. And again, these are consistent with what we had discussed last week. I just put them there to make sure they're on everybody's radar as we move toward the end of the first round of 8 weeks. We have some folks in week 6 and not 7 at this point. And then in closing, just some general forgiveness considerations that we have been discussing. I think the key point is I would not necessarily be in a rush to apply for forgiveness. And why would we make that comment? Well, first of all, there's a potential for an extension of the 8-week forgiveness period. So here we are, as I just mentioned a minute ago, heading into week 7, if not already there for some of the earliest recipients of these funds. And there's still talks in Congress about extending them to 16 weeks, maybe 24, maybe to the end of the year. And there's potential for votes to happen as early as this week. So we don't know what those bills are going to look like and if they're going to have wings. But I hate to see somebody rush their forgiveness, get an extension right thereafter, and find out that we really can't pull that forgiveness back. That's something that has not been addressed, is if you can, kind of say, time out, I want to do a redo. Tom mentioned the superseded tax return earlier this afternoon. Can we do a superseded forgiveness application? We don't know. Also, there's still clarifications on some forgiveness items that's lacking, in our opinion. This may ultimately be favorable to you. And if you're not one to take risk and be aggressive with things like the retirement and maybe some of those payroll, maybe if we wait a little bit, have 16 weeks, all those issues really become, non-concerns because we then have enough payroll to achieve full forgiveness without having to take any aggressive positions. Also, there's a question of the tax deductibility of the forgiveness funded expenses. And not necessarily that would make you in a vacuum delay your forgiveness application, but just something to keep in mind. And then the government contractors and impact on their overhead audit rates. Those are 2 other items that, again, it gives you a little bit more time to assess those impacts. And the one item on here that I see that I failed to add in my planning was the longer you wait to submit your forgiveness application, the longer you can forgive or continue to defer your employer portion of the FICA tax. So as we mentioned several weeks back, the IRS is allowing you to continue to defer those items up until the point that forgiveness is determined by the lender of the SBA. So that can be quite a while. You think about the 60 days, the 90 days, plus if I wait a couple extra weeks to submit my application, I can extend that and have a nice cash flow bump just to help tide over until things reach a greater degree of normalcy. So that's everything I have on the PPP front this week. I'm going to turn it over to Kristi for some more information on HR and the workforce front. Thank you.
Thank you, Chad. Hello, everyone. Good to see all of you. I really don't have much from a regulatory standpoint to update you today. I just want to give you a friendly reminder that as you're bringing employees back off of layoff, they may not have seen the Department of Labor fact sheet that provided an overview of the paid sick leave and the extended FMLA leave. That is good until the end of the year. So if you've posted it on a bulletin board, just show those employees returning where that is, letting them know what's available to them and what they should do if they find that they need to use that benefit. And certainly if you haven't posted it on the bulletin board, consider doing that as soon as you return to the office and open things back up, but also electronically is another acceptable means to get the information out to your employees, especially if they're teleworking and so forth. The one other point that I wanted to make to you is that Pennsylvania has made a decision about workers' compensation as it relates to COVID-19. So not quite sure how this is going to play out with all the states, but thought I would share a little bit about it. That way you can at least keep it on your radar just in case it does start extending into other states that you may or may not be doing business in. So what Pennsylvania has said is that it would be a qualifying claim potentially if somebody was exposed in the workplace and there was evidence to prove that. What they did say, though, is that it will not impact your company as an individual or individual company's experience rating. Very similar to what we had seen with unemployment, you're not going to be negatively impacted. So there will be at some point probably a cost sharing of this, as there may be potentially significant claims. And with that, it might just be an overall across the board increase, but it would not be impacted to you as your organization if you had maybe 5 claims and the next company had none. So just wanted to share that with you today. And certainly we'll continue to monitor this and let you know if there's anything more to add. So at this time, I'm going to ask Rick to come join me on the screen as he talks about the future and gives us some more things to think about from an anticipatory perspective. And then he's going to introduce our guest speaker. So there's Rick. You want to test your audio, Rick?
Can you hear me okay?
Yep.
Perfect.
You're good. See you soon.
Again, thanks for everybody joining us again. And the theme throughout our recent panel discussions has been to discuss those key operational areas from more of an anticipatory mindset, encouraging you to identify those disruptors that you're going to encounter during your roadmap to reentry. Certainly, there's been a lot of those already, and there's more to come. But the ability to apply the concepts and principles that are presented by Daniel Burrus, the futurist, author, well-known speaker in his book, The Anticipatory Organization, challenges you to alter your mindset from past and present and take on to what Burrus refers to as a future view. Yet doing that focuses on those areas that you have a much higher level of certainty of them happening. And these are future events that are going to happen. No matter who you are, what you're doing, there's nothing that's going to stop them from happening. But there is a way to become proactive, identify the disruptors, and try to solve them even before they happen. Burrus has identified 3 categories in this area that he refers to hard trends. And the first category has to do with technology, that linear exponential change. It's happening so rapidly. And last week in our panel discussion, Susan Patrick, our Director of Client Solutions, shared her insights surrounding ERP systems and what you can be doing now and looking for those opportunities, to implement those. The second category that Burrus talks about is regulation. Need I say more? If you haven't had enough on regulation with the stimulus, but more is to come, and you can only anticipate that with public safety, the changes in technology, there's going to be additional disruptors that you need to be thinking about. But the third one is the area of demographics. And Kristi Weierbach, who's part of the panel discussion, frequently speaks about this hard trend in her next-gen webinars. The fact that there's almost 78 million baby boomers in the U.S. that are continuing to get older. You don't have to tell me. I'm one of them. Not getting any younger, and that's a future certainty. So what are the predictable problems? What are the opportunities that we can look at, that we're going to be certain about? The eventual retirement of the baby boomers, we can see that with certainty. There will be a significant level of ownership transfer taking place and succession planning required. So that brings us to our presenter. I'm going to ask Valentina Madura to join me now on the panel discussion by clicking on her webcam and her audio. Valentina Madura is the Senior Managing Director for BDO Capital, who's going to share some insights on COVID-19, the impact that it's had on the M&A market and capital markets. So with that, I know, Valentina, we have some slides that they'll be sharing with you, but thanks for joining us, and we're anxious to hear what you're seeing out there in the M&A world.
Thanks a lot, Rick. Appreciate you allowing me to join this session. There's been so much great information already shared. And you raised a lot of good points. It's being proactive. I've been in investment banking for 22 years. I'm always surprised how little time sellers think about selling their company in advance of actually engaging us to take them to market. I think what this disruption in the marketplace has taught us is that we need to now sit back. We need to include discernment of our businesses, of our supply chains, and have a much more proactive and methodical approach to a future exit strategy. I think what's changed most in the last 60 days, if we kind of go back to March 13th, we had a paralyzing halt to the market. Deals that were in the market came to a paralyzing halt. Banks went on hiatus. And really, if we go forward then to today, and I think Tom mentioned this, you've had some shots of adrenaline pumped into the system from stimulus packages. And so that has developed some economic progression. I think the biggest change we're seeing now, and maybe if we can move to the first slide, I can reference this. But what we're seeing is that instead of deals being transacted because shareholders are trying to maximize their value, we're seeing deals that are driven by liquidity. And you can see here, I've kind of listed a few of these sectors. So specifically in the next 30 to 90 days, we're seeing spinoffs, distressed deals, minority investments, which may not be liquidity driven, but are a way for sellers to get some liquidity and still maintain some control of the business, and then highly structured transactions. We are seeing some strategic deals still come to fruition, and that's going to happen if the synergies can outweigh traditional valuation metrics, and we'll talk about that, in a few slides. Consolidation of weak players. This is where buyers can take advantage of the marketplace. Anytime there's a downturn, the transactions that are consummated in that period of time from a buyer's perspective, it's the highest return that those businesses get. So if you have capital on the sidelines and you want to put it to use, this is the time to put it to use. And then there are secular trends that are developing. I mean, you mentioned technology. Tech deals are still being transacted. We'll talk about some of the segments that are in favor and not in favor, but you can see deals being transacted in those areas. So I guess in short, what we've seen change most in the last 30 to 60 days, leverage is out, structured deals are in, and the traditional M&A market just isn't faring as well.
So, Valentina, what are you seeing? Is there much activity that you're having people approach BDO as far as possible transactions?
So, I think what's happening, and I've actually had this conversation with sellers. I had an inquiry about 30 days ago from a potential seller, and they were in the retail upholstery market, and a very large business. And I said, you want to put this on hold. I wouldn't even think of taking you to market at this stage because it's too uncertain. You're a very fine business. You have no liquidity needs. Just, steer the ship correctly over the next 60 days, and then let's get you to market. I have other deals, however, specifically a tech deal in the supply chain industry. We're launching in 2 weeks. We've talked to the buyers. We are out there actively discussing what's happening in the marketplace, and those buyers aren't on pause at all. Their valuations are still high, which means they can transfer that value to a seller. So it's very industry dependent, and I think as we kind of shift to the next slide here, I can kind of go through the stages of different deals, because It also depends,
Okay, great.
were you already in the market or are you preparing to go to market? So, as I said, everything has changed in the marketplace, from preparing to go to market, how the buyers are doing their due diligence, the process to close the deal. Everything has effectively been elongated. And probably the easiest way to address it is looking at the various buckets. So I have here kind of bifurcated deal flow, and this would be for any banker, including our practice, in terms of the late stage deals that were in market at the LOI or SBA stage, deals that were launched, and then engaged but not launched deals. And if I look at those late stage deals, any deal that was contingent on financing to consummate the deal, it came to a halt. And it's not getting restarted until the banks reopen. And as far as we understand, the banks are reopened for high priority deals, mission critical companies, but they're not for the broader base of the market. So those deals are at least on hold, I would say, for about 60 days. But the other thing that's happening is that with those deals, and I've also had instances like this, we had a deal that was in due diligence, would probably have closed at the end of April. There's been a reevaluation of the deal terms. Can we still get this deal done if we pull out the financing that was in the deal already, and can we replace that with an earn-out or seller note? And I'll refer back to that when we talk about valuation. But restructuring is an option. So to what extent will a seller finance some of that deal? And then the other thing that needs to be evaluated, even with those deals that were at the late stage, is they've been put on pause so that buyers can say, okay, what is the impact of COVID-19 on the supply chains of this business? How is it impacting the valuation and the long-term revival of this business as the economy turns? And that's where we've had this 30 to 60-day pause. I have a business right now. They do underground infrastructure repair down in Florida. They're serviced by the municipalities. That's where they're getting all of their funding. Those projects are not on hold because they're mission critical. They have to continue. So that deal, albeit we switched buyers because of financing, that deal is moving forward to try to close. And I guess I'll have more insight to that in the next 30 days. But the backlog hasn't drifted off, and the demand is still there, and it's still a mission critical, high priority service company. So that particular deal has a high probability of closure. Then we look at kind of the launch deals. So these are deals that maybe we put into market in January and February. And this is really where, I've seen buyers and sellers both say, okay, let's take a breather. We need 30 to 60 days. Allow the seller to focus on the business. Make sure that we're tending to our employees and our customers. If we need to migrate to an online platform, let's focus on those things. Let's put the deal docs and the process on hold. And even in this time, this is where there's a higher level of scrutiny around due diligence. So the buyers, even though they probably have completed most of the due diligence, they're going back now and doing that due diligence again, because again, they have to understand what changes have happened. And then with those deals that are engaged but not launched, this is really sector specific. So as I said, I have a software company. I'm putting it into market in 2 weeks. I also have a company that does interior design construction in New Jersey. Well, that deal is on pause. And I said it's at least on pause for probably 60, 90, maybe 120 days, because we don't know how many of those projects are going to come back online or how quickly those projects will come back online. And so you really can't put forth a backlog or projections to a buyer, and without that, it's too difficult to value a deal. So again, I think that we've got to look at, industry-specific deals in terms of deals that aren't launched, and the deals that are launched are at late stage. How impactful has COVID-19 been on the business itself? And if it hasn't been impactful, keep moving forward. Try to restructure with different terms and conditions. If it's been impactful, you just got to take a step back and organize the business around the new normal. And really focus on the metrics, because deals will get valued based on the extrapolation of metrics before they get valued on the basis of cash flow.
I know you were talking about transactions pre-COVID, and this is one of those necessary evils, the due diligence. And this has just opened up a whole bunch of new things that people are going to have to think about when they're going through that process. And I know you may speak to that here later, but it's certainly an additional layer of effort that's going to have to be incurred.
It is. I mean, there's been a complete transformation in terms of due diligence. I think first and foremost, the biggest change we've seen that's been impactful from a deal standpoint and from a seller's perspective is valuation and structure. Maybe if we go to the next slide, I can speak to that. And this is unfortunate because we went from a seller's market to a buyer's market in literally 0 to 60 seconds. And as an investment banker, when you're in a seller's market, you've got competition, you're dictating terms, you're driving the value of a deal up by 30, 40% just through a few phone calls. And then when we get to the buyer's market, everything is upended. So the process has been in an upheaval, but then valuations and structures are really what suffered the most. If we look at valuation, the interesting thing is you're normally going to value a company based on its EBITDA with an associated risk. You've got to figure out what that risk is. The issue right now, if you look at, sellers that are on this call or business owners, if you're looking at your business, you can't project out 30, 60, 90 days what's going to happen to your business, let alone, 12 months or 18 months from now. If you can't calibrate the risk of that business, nor can a buyer. So without that ability to calibrate the risk, what a buyer will do is they will offer a reduced level of value, and that's going to be in disequilibrium with what your expectations are as a seller. And that's where you see this dislocation right now. I even had a company, I had a seller, their service-based business, literally should have closed 30 days ago. And we had a deal on the table, mostly cash with some equity roll. And then as a result of COVID-19 and changes to their EBITDA, we went from, cash equity roll to cash, significant seller notes, significant earnout. And I was trying to evaluate the earnout along with my client, and I just said, there's no way to do this. So the other thing that we've seen is even if the buyers, and they're doing this, they're honoring pre-COVID multiples, and they'll look at the comparable companies in the marketplace and they'll assess those multiples. The problem is, what is the multiple off of? And everyone's experienced a 30 to 40% drop in their EBITDA. So now is the multiple off of the new EBITDA? Because that's not the run rate EBITDA of the company under normal conditions. That's really where this location starts. And I said to my client, they seemed wanting of a deal. And I looked at them and I said, I can't let you do this deal right now because this is not representative of your run rate. We need to make sure that we get back to your run rate or even get back to the point where your metrics can be extrapolated to a reasonable run rate, and then we'll talk about structure. But in terms of structure, and this is where it's been a little bit confusing because the equity markets, the performance in the equity markets have been incongruent with what's happening in the economy. So yes, we can still uphold to those multiples, but when we look at the actual structure of the deal, what's happening is everything is now contingent based. If you can't calibrate the risk, but you still want to afford a valuation to the seller, then they're going to change the structure around. So now instead of having cash, we've got earnout, or worse, what we're seeing is esoteric security. And so where we're doing deals with private equity firms, what I mean by esoteric securities is typically you're familiar with common stock or you have convertible preferred stock, but you also have this security called participating preferred. And essentially, without getting into too many technicalities, the participating preferred stock allows the buyer to double dip. So they get to protect their downside, and as well, they get an enhanced upside participation, but the seller gets no protection on the downside and limited upside participation. So when you think about it from a seller's perspective, if you're unfamiliar with those securities, but the purchase price is still the target number you're looking for, you may get into a situation where you don't understand the true value of what you are signing up for in that type of deal structure. So big changes between valuation, again, off of what threshold of EBITDA, and then structure. Are we talking about earnouts? Are we talking about esoteric securities? Everything has just become much more convoluted. And from a seller's perspective, you need guidance. You need somebody that's talking you through this, whether it's, your accountant or your lawyer or an investment banker, someone that's educating you on all of these different structures, because while they won't seem impactful on the day of close, they have significant and severe ramifications upon a second sale. That's probably the biggest thing we're seeing. If we kind of flip the tables now, if I'm a buyer, and I've talked to a lot of prospects about buy-side work, this is a perfect opportunity to be in the marketplace, seeking out those businesses that need liquidity needs. And now let's structure favorably. Let's reduce the cash that we have to use at close. Let's use those esoteric securities. Let's use the earnouts. Let's use seller notes, and let's structure this so that it's a leverage deal, but from a seller's perspective and not from a buyer's perspective. So again, it's unfortunate that we've moved into this buyer's market, but if you're a buyer, you're in the right place, and you probably have, I would say, 12 to 18 months to take advantage of the marketplace and go out there with some capital and try to effectively create an arbitrage opportunity. That's what you're doing. You're going to buy another company, you're going to add their EBITDA, you're going to increase your multiple, but you're going to do it with probably the least amount of cash outlay that you need to put out in probably the last 10 years.
So it's very true. I mean, the key thing here is giving yourself enough runway to plan for all this stuff, particularly with all these changes, and make sure you're asking, as we keep encouraging people, take this anticipatory, identify those disruptors that you're going to have so you can, plan for them in the future. I think, is there maybe one more item you wanted to cover? One more slide?
Yeah, well, you talk about the disruptions and planning for it. So the one thing I would just say is, when we now look at businesses, what are the key things that a company should do? And I'm really referring more to sell-side businesses at this point, but what can you do now? I would say that there is no better time and no more needed time than today as we're navigating COVID-19 for sellers to look internally and prepare for an exit strategy. You mentioned the baby boomer generation. You really need to not be proactive and let buyers come to you, because they're going to come to you with very highly structured deals. You want to make sure that you are developing your business. And there's a few things that I cited here that I think are most important. First of all, when we look at what's going to happen once we kind of get beyond COVID-19, we really do anticipate a quick rebound in the marketplace. And this may seem counterintuitive, so I'll just take a moment to kind of explain what I mean by this. M&A is a precursor to a market downturn, but it's also a precursor to a market rebound. And if you look at the activity of M&A since 2017, we've actually been experiencing a precipitous drop. So it may not seem like that because everyone thinks we've been in this bull market, but if you actually look at the numbers, the number of transactions transacted have gone down. So we've already been in this downturn of the M&A market. So now we're kind of in it with the economy, but the M&A market should precede a rebound in the marketplace. So if it takes us 2 years to come out of COVID-19, it's going to take us 1 year to come out of the M&A drop. So really, we're looking at the beginning of 2021 for a rebound in the M&A marketplace. So for companies that are kind of thinking about what they need to do now, I would start preparing and thinking about some of the things that we have here. So in terms of reviewing your strategic plan, it's critically important to look at, as a seller, what is the time frame and what you need to get your house in order to prepare for a sale. And it was a little bit easier, I would say, 24 months ago, because if you were a strong performing company and you had really good metrics, you could build a very quick narrative you could get out to market. But unfortunately now, building a narrative is taking a lot of extra work, because you're building that narrative based on what the company looks like outside of the pandemic. And because we're not outside of the pandemic yet, you need to make a lot of assumptions and you need to think through supply channels. So the first thing is assess the long-term growth of the business within your industry. So what's happening in your industry and what sort of long-term growth can you reasonably project? And then you need to think about that pre-coronavirus. So how are you performing pre-coronavirus? And how would you perform post-coronavirus? And when I say pre-coronavirus, I don't mean just before, meaning January to February, because I can tell you every single privately held company had the 2 best months of their entire life cycle in January and February of this year. What I'm really referring to is probably, I would say, 18 to 24 months ago, when we were just kind of coming up to this peak in performance. What was your sustainable EBITDA then? That would be a realistic point to say, okay, that's what the EBITDA is of the business. And now the question is, how long is it going to take us to get back there? So that's the first assessment. The second assessment is, what has been the impact on the virus on the company's supply chain? And whether you need to do this internally or hire outside consultants, that is an assessment that you need to perform, because that's exactly what the buyer is coming in and doing. And you don't want them to be assessing it differently the way you're assessing it. And thirdly, you need to look at the immediate visibility on your business performance, taking those two things into account. So the impact of your growth rate vis-a-vis what's happening to your supply chain, and how does that affect the immediate visibility of your business? So you can have visibility in 2 months, in 6 months, or is it going to take well beyond a year to get that visibility? So this is a narrative that's going to take a while to develop. And what you want to do is, you don't want to wait till the market rebounds to develop the narrative. You want to start to develop it now, because as I said, what you can start doing is tracking KPI. So that's the fourth thing. You need to look at, the third thing, you need to look at your performance metrics. And performance metrics are incredibly invaluable, because you can take those performance metrics and you can start to extrapolate. Let's just take a service-based business, and let's say you're adding 10 new students, if this is online education, per month. Well, if you're adding 10 new students in the first 2 weeks and 20 new students in the next 2 weeks and so forth, you can easily extrapolate that over time. That gives the buyer confidence. And buyers don't want to be at the point where the market turns and they've got to pay the top multiple again, but they're willing to pay a strong multiple for a good performing business. So if you can use those performance metrics to extrapolate the business performance of the company, you have a really good shot of getting a very well-valued deal in probably, I would say, the next 60 to 90 days. But you've got to do that homework. And it's something that, I don't think that businesses have taken the time to perform company discernment. They're usually reactive. And you've said it before, these are changing times. You can no longer be reactive. You have to be proactive, understand what's happening in the industry, and understand what you need to do, which really gets me to the final point here, which is performing complete analysis of the supply chain and the impact of the disruption from a diligence standpoint. Buyers are more forensic than ever. What took 30 days is now taking 60 days. And if you've ever been through due diligence with a private equity firm, every day is 100 more questions and 100 more assessments and analytics that you have to go through. So they can slice and dice things a million different ways. And so you need to take a forensic approach to evaluating your business as well. So again, I mentioned completing the analysis of the supply chain, but you also have to look at now, how is that impacting your receivables, your payables, and your working capital? Because that's how they're going to be looking at the business as well. So cash streams, working capital, what's happening with your supply chains, how are you getting your payables paid, and how are your receivables, how are they changing, or how are your inventory levels changing? All of those things you need a much more, I think, discrete and forensic view of in order to establish a narrative to then take your company to market. As I said, whatever advisors you're reaching out to, I don't think that a company should be going through this independently, because the one thing that we are uncertain of is the change that's forthcoming, but we're certain that there's change. So we're reacting as quickly as we can and trying to give our clients guidance and saying, okay, this is what we should be tracking, but we don't know what's around the corner. And I just, I know, having worked with businesses in the past, they're so good at their own business, understanding their business, but they're not as sophisticated in the area of M&A. And I've seen buyers come in and they put in this crafty language in these esoteric securities. And unfortunately, sometimes those sellers they're just not educated around the process enough to understand what that means. So this is really the time to reach out, connect with your accountants or advisors or legal attorneys, and get that guidance, and make sure that if you are contemplating a sale in the near term, and I really mean in the next 12 to 18 months, because as I said, I fully expect the deals that I have tabled right now, I fully expect that they will close before December 31st because they were at that either late stage or launch stage. The deals that I have that are engaged but not launched, depending upon the industry, I would say they'll close somewhere before December 31st, and then depending upon the industry, towards June 30th of next year. So we're not talking about a significant setback, and I know sometimes it's difficult to kind of internalize that given what's happening in business performance. And I will reiterate, focus on your employees first, focus on getting the loans that are necessary to make sure you have the capital to run your business. But when time permits, then step back and start taking a very discerned view of the business, understanding the supply chain, and understanding how to build growth in your business.
Well, again, Valentina, I can't thank you enough for taking the time not only to prepare for this, but just to share your insights, because this whole idea that we're trying to convey to clients, if you're looking at some of these opportunities, and there are opportunities out there, it's no better time. You got to plan ahead and anticipate those things. So with that, I want to thank you. And if people have any questions, please lob those in under our chat. If Valentina can't respond to them today, we'll see that we get back to you here. So with that, I'm going to ask Kristi to rejoin the group here with some of the other members of the panel. And again, our many thanks to Valentina for joining us today.
Thank you. Thank you so much, Valentina. That was great. A lot of notes I was able to take from your session. So if I could get the rest of the roundtable to join me here, we're going to continue the conversation on the M&A. Let's see, Katie and Darren, great. Thank you. So one of the things I really enjoyed that you had shared, Valentina, is that you need to focus on your employees. So I'd like Katie to take a moment to talk about why. Why is that so important that the employees have to be focused on, and why it's important to have HR as a seat at the table?
Absolutely. It's interesting because when you think about everything that was just covered, and the thing that kind of bubbled up through that was the employees. And those of you that have a dedicated HR person at whatever level they have, really lean in on this person. They are going to be able to help you, give them an opportunity to help you, give them a seat at the table so that they can be strategic with you and help kind of put together a plan. Yeah, there's the talent war out there. We already had that issue before. And now with everything with COVID, it kind of put a huge microscope on that. So again, just making sure that your HR person has a seat at that table to help you. Don't forget about that. A lot of companies, I think they think about that afterwards, because you can see, based on what was just covered, there's a lot of information to consider. But don't forget about your people.
Thank you, Katie. Yes, definitely. And, as we think about the war for talent, there might be more people available now, but is it the right type of person that we want to hire? I guess time remains to be seen, but I think about M&As that maybe aren't handled properly might be a good place for us to pick a few key talented individuals to bring to our team. So you definitely have to use a strategic mindset when you're thinking about just your recruiting and retention strategies, and how can you make an opportunity out of this, maybe where a company had a shortcoming and so forth. So I'm not saying to be vicious or negative, but there is friendly poaching that can happen. So Darren, with everything that Valentina had shared, what else do you have to offer as far as strategies for businesses in this environment?
Thanks, Kristi. Can you hear me? Good. I guess the comment I wanted to make was I think Valentina's presentation fits really well into the topics that we've been covering in these town hall sessions in the last several weeks, because, I think if you're not a buyer now, everyone at some point is going to be a seller. And I think most people want to get the most value out of your most significant asset as a small business owner. So, thinking about value creation, if you're taking a medium to longer term view here, you should look at this time as an opportunity to create value in the future. And I think Valentina already made that point. And how you do that probably looks different for everybody. But there are numerous studies that suggest that investing in a downturn will reap rewards in the recovery phase. And so, those investments can take several forms. They can not only be money, but sometimes just investing some time into strategic activities in your organization. But at the end of the day, it requires business owners and managers to spend time working on the business and thinking about other external factors that will influence the business. And, connecting that concept in with some of the things that Rick has been talking about in recent weeks, you apply those anticipatory strategies and you start to improve your success rates in whatever tactics that you do apply.
Rick, do you have anything to extend to what companies can do strategically to add value to their organizations outside of what you already may have shared?
I think in addition to what both Valentina and Darren said, but I keep coming back to what we mentioned about the due diligence, and make sure that you're thinking about that. I mentioned in my earlier commentary to Valentina that that was always a challenge in the past, and to the extent that somebody is in that mindset, I don't think you can start soon enough to be thinking about those things, to posture yourself so that you don't want to get to the 10-yard line and not be able to get the ball across the goal line because there were some oops or some things that people didn't think about. So it's this whole effort of anticipating what those potential disruptors might be. I don't know if Valentina has any war stories to tell us, but I'm sure they're out there. I know that one of the big areas that we've seen is dealing with our state and local taxes. Our SALT practice being anticipatory, making sure people are addressing those challenges.
Yeah, I guess the one thing I would say is I've seen deals fall apart and unnecessarily because of due diligence. What you want to have is you want to have a process if you're a seller that has momentum behind it. And so our ideal situation is being engaged with a business a year before they want to sell. Now, how often does that happen? Probably 10% of the time. As I said, it seems though it's a knee-jerk reaction. Either buyers approach the company or they just have an epiphany and they decide this is the right time to sell. But it's that year before where you really think about what do I need to do internally to get my house in order. And if you have any sort of manufacturing type of operation, a phase 1, a phase 2, that type of due diligence critically important. Or on the employee side, you want to put employees under agreement before sale process. I really think that you need to go through and kind of do that house cleaning before going to market, because what you wouldn't want to have happen, you negotiate a great deal, you're streaming towards the close, and it comes to a grinding halt because of due diligence. I'll also just kind of echo what Darren said, because it was a great point. I didn't include this slide, but we have statistics that show the returns on deals transacted in 2009, so just coming out of the great financial crisis. They were the highest returns over the past 30 years. So for buyers or sellers that have capital on the sidelines, you're not getting an organic growth return over the next 12 to 24 months unless you're perhaps a tech company or otherwise. So looking at scooping up an acquisition target, adding that EBITDA, rationalizing costs, that may be an opportunity to add value so that when the market turns, and if you are a potential seller, you've created value in this interim period. And unfortunately, there's not a lot of businesses that have the foresight to build up that capital. So if you are one of those businesses, and at least in this time of reduced leverage from the banks, this is a perfect time for you to go out and take advantage of some of those targets that are out there.
So if we extend the due diligence conversation a little bit further, Tom, what have you seen from a state and local tax perspective that could really put a company at risk during this process?
Yeah, well, I think a couple of the other folks already kind of touched upon it, especially with some of Valentina's comments. But, Rick referred to what we're talking about here being the hard trend of demographics and transition. But I would point back to the other hard trends of technology and regulatory, that not only do you need to have your house in order today from a state and local tax standpoint, we've talked about in prior town halls what we expect to be coming down the pike here in the response to COVID-19. We have a lot of broke state and local governments, so they're going to be enforcing their existing tax laws even stronger. They may be raising rates, they may be introducing new taxes. So there's no time better than the present to get your house in order and be filing in all those places you should be filing, have all that taken care of, because as I'm sure Valentina's seen it, we've seen it too, it can be a huge hit to the value of your company when that stuff is uncovered during the due diligence process. We sound a little bit like a broken record. We've said it several times in past town halls, but I can't emphasize the importance of that.
Kristi, I'd like to. Can you hear me? Yeah, I'd just like to make a comment as well about, we've been talking about taking a proactive stance. And that can be, again, whether you're a buyer or a seller. But one of the areas that, I think if you're wanting to enhance value, I would imagine, looking at one of the trends that was already in play, and I think is going to only accelerate as we go through this recovery process, is a topic that Tom briefly introduced at the beginning of the presentation today, and that's digital transformation. I would imagine that, as M&A activity begins to rebound, that's probably an area that companies will be looking at to see, if a target has made appropriate investments, not only in technology, but in a lot of other areas in their business.
That's a great point. Valentina, what has your experience been when you've been at the table? How heavy does technology weigh?
So, I think that this is changing because of COVID-19. Historically, if we just talk about ERP systems, if a seller implements an ERP system and the buyer comes in and buys the business, they're probably transferring to the buyer's ERP system. So you're not really getting the return on investment there. But because of COVID-19 digital transformation, I don't think that there's a single business out there. If you don't have an online presence, it's impossible to navigate this particular time in the marketplace. So I think that digital transformation needs to take place to have an online presence, be able to transact online. And then in terms of supply chain, electronic data interchange, extremely important. I mean, these are businesses, sometimes they don't get around to it, they don't think they need it. This is something that's been around for decades, but making sure that you have a vendor that can provide you with EDI and there's not a disruption in your purchasing or selling of products online.
Thank you. Does anybody else have any comments?
No, but just Valentina, I know in some of the information you've shared with Stambaugh Ness over the years, and you alluded to this earlier, there's like a trend, kind of peaks and then it valleys, as far as transactions. And you referred to that coming out of 2009. So there really are some opportunities, possibly, people here are looking at this trend. And I think that, to your point, it's not going to be too soon to start thinking about this, depending on where you are on your runway, because they do come up. And we've talked to clients that you want to kind of be going on the upside because you may not be able to make it through the downside and coming back up again.
Right. So I think that the thing that's important here, and I don't know if I mentioned it earlier, but we didn't experience a financial crisis. We experienced a healthcare pandemic. And that's the key difference between this downturn and what we experienced with the great financial crisis and what we experienced with the tech bubble. Those were financial crises, and this is a healthcare pandemic. So the market actually had an exceptionally strong foundation going into this. That's why we believe, again, depending on how quickly people can get their supply chains back up and running, that there will be a quick turnaround to this, and that as soon as businesses, the lockdown is is eased, businesses will restart and we'll start to see those opportunities come to market. So for sellers that were just on the tip of selling, I don't think they're waiting another 3 to 5 years. As I said, and you mentioned this, Rick, these peaks and valleys, the way that the market is typically operated, and it certainly didn't with this last bull cycle, but you're really 2 to 4 years down into an M&A trough, and then you come out of it and it's 3 to 5 years up. Well, we hit the peak in 2015, and then we kind of hovered around that in 2016, 2017. Like I said, we started to see a precipitous drop. So we're already on the downside that we should be, in theory, coming out in 2001 and working our way back up. Now, for businesses that are desperate, they're not waiting, till we get to 222 or 223 to hit the apex again. They probably need to sell before that. But the point is, prepare now to launch into market. It does take about 6 to 12 months to actually consummate a deal. That while we think there's a lot of time here, to time the market cycle appropriately, you should really be starting now to do the internal housekeeping on the diligence front, and then preparing that narrative, tracking those KPIs and other performance metrics, and building that story so that when your business starts to turn, you're selling on the growth trajectory and not when it's flattened out.
Great. Anybody else have any thoughts or questions? All right. Well, thank you, everybody, for participating in today's roundtable discussion. I'm going to pass it over to Tom, who's going to take us through the Q&A and then finish out our day.
Thank you, Kristi, and thank you, everyone on the roundtable, and especially thank you to you, Valentina. Invaluable information for us here today. So I'm going to check in here with Kaylee and see if we do have any unanswered questions that you can direct out to us that we can handle here. We do have a little bit of time left today. Anything for us, Kaylee?
Alrighty, Tom. Sorry about that. I was on mute. We don't have any questions that we can answer on live because there's none in the queue. So this is just a last-minute opportunity for any of the attendees left with us today to submit them so our presenters can answer them live. If not, this is just a reminder that the Q&As will be sent out to you via email for anybody that wants to view those. So I guess, Tom, if you want to walk us through here, and then we'll see if we have any questions come in.
Okay. Well, we can look at our remaining material here before we and circle back if any questions do come in the last couple of minutes. So maybe if you could advance there a little bit, Kelly, maybe to the next slide. We did just want to remind you that we do stand on the ready here at Stambaugh Ness to help you out in any way, not just certainly what's directly related to COVID-19, but in particular, some of those things we talk every week so much about the Paycheck Protection Program. We certainly are willing and able to assist you with putting your forgiveness documents together, with vetting those calculations out. If you do have one of those loans that's over $2 million, that may be subject to question on whether you were eligible or not, we can assist you with putting the documentation and the rationale together for that as well. As Chad noted, if there are any of you out there that haven't jumped into the PPP program yet, but may be eligible, there are funds still remaining. I believe over $700 billion was allocated, and I think Chad showed some numbers that we're in the 500 and some odd billion allocated at this point. So even if you're coming in later to the game, we can help you out with that. The next area that we can help with would be the technology area. Certainly, as we said, we're going to talk about digital transformation and its impact in our upcoming June 9th town hall. but Phil Keeney and his group are certainly ready and willing to help you if you're still trying to establish your security, your cybersecurity policies, gearing up your workforce to be even more efficient with working remotely and things like that. We also, Kristi's group can certainly help out on the workforce side of things. It's slowed down maybe a little bit because I think this was really the hottest area in the first couple of weeks of our town halls as the shutdown went in place and so many people went on unemployment. The various leave acts, the forced payment of the leave and all that. I think we're going to see this kind of ramp up again here as we approach the end of the second quarter and we have to jump into the filings of the Form 941s to account for all of that. So Kristi and her group stand ready to help you answer your questions or work you through that. And then certainly on the tax end, we've had a lot of tax changes, obviously, that have come about already through the two acts that we've had so far, especially the CARES Act, maybe a lot more coming if the HEROES Act or some form of that passes. But certainly we can help you out with the things we've talked about at length in prior weeks, the R&D tax credit, doing your tax planning around the taxability or non-taxability of the PPP loan forgiveness and deductibility of the related expenses, the new net operating loss rules, the new depreciation rules, and many, many other items there. So, in any of those items, we stand ready and willing to help you out. Please just reach out to us if there's any way at all we can help you with that. So I'm going to just jump back to Kaylee. I believe we may have had a couple of questions come in while we were talking here. So Kaylee, if you want to send those out our way, we'll see if we can answer those.
Sure can. So I believe this is going to be PPP related. So Chad, if you could help us out here. It says, when will more guidance come out for companies with semi-monthly payrolls?
Can you hear me?
Yes.
Sure can.
Okay. I'm not sure if there'll be any guidance specific to semi-monthly. I think by them carving out and clarifying that the alternative covered payroll period excludes those payroll cycles, I think more or less that may be the last of the guidance that we're going to see for those on the semi-monthly pay cycle. I may be wrong there, but I think they may have given all they're going to give for the pay periods because it was pretty heavily hit on the last interim final rule.
Perfect, thank you. And while you are on unmute right now, I have a couple more questions for you.
Sure.
It says, we pay out good attendance hours every 6 weeks. Do those hours count on the FTE calculation? Also, unused vacation hours are paid out on the employee's yearly anniversary. I am assuming that gets counted as salary either during 8-week time or the first quarter for the salary reduction calculation, correct?
On the good attendance hours, I would equate that to a bonus of some sort, and those are factored into the wages for the forgiveness. Now, when we're looking at things like the FTE calculations and things like that, it's not really clear if how those hours would factor in. I would think if you're going to count hours for somebody that's not working, based on their average schedule and what they would be working, that perhaps those good attendance hours would count as wages. I think it would really depend on what that looks like with your payroll records as well, because think about what you have to submit to the lender on the back end. Do those show up in your hours worked for those employees? Is it something that could be auditable by the lender or the SBA to support that claim? So I think I would tentatively say I think they would be eligible. Not 100% sure, but I would look to what the documentation looks like. In regards to the vacation hours, again, I think it works the same way in regards to the calculation on the FTEs. And depending on when that occurs, when that's paid out, you look to the date of the checks. I think that would be really what would drive it, not necessarily the date of when it was incurred, because that's just the payout is going to be what matters in that situation.
Alrighty, and another one for you, Chad. Is there a requirement to put PPP funds in a separate account?
No, there's no requirement. It's something that has been recommended, both here and from some of the other individuals that are looking at these loans. It makes it a little bit clearer and cleaner in terms of tracking the information. We look at what information needs to be provided to the lenders. They want to see bank statements and things like that. And I think it may be clearer to see the transactions without them having to wade through other types of activity that's not PPP related. But there is no formal requirement to do so.
All right, and I'll give you a break for a quick second here. So this next question is for Kristi. It says, current guidelines on child care payments under FFCRA now that schools are closing. People should have had summer child care arranged as in past years before COVID. Do we still have to pay them for their time off under the FFCRA?
If that child care is their primary source, or the camp is their primary source of child care, and the facility is closed due to COVID reasonings, then yes, they would be allowed to use the extended FMLA during that time frame. So the critical piece there, which was clarified in the most recent Department of Labor FAQs, so if you go to the Department of Labor website on their COVID page, they have frequently asked questions. We're up to 90-something now. And in there, they specifically talk about this scenario, and they lean really heavy on the COVID-related reason for the child care to not be available. So if you have specific questions, I can answer those separately if it's unique to your organization.
Thank you, Kristi. And Chad, another one for you. It says, I previously thought someone had mentioned owners were excluded from FTE calculations. Above, I see, which they are referring to the questions box, it says that they should be included. Could you confirm or deny?
Chad, you may be muted if you're responding.
Sorry, I'm not making me unmute myself twice. So I was just checking the table here to see what that looks like. I think that comment likely was stemming from the fact that a lot of the owners are going to make more than the $100,000 limit, which moves you from table 1 to table 2. So the FTE reduction exception is a little bit differently applied. But unless I'm missing something, I don't see anything that specifically carves the owner group out from the FTE calculation, other than the 100,000 and then some different wage limitations. But I think they get counted in as if any other employee, unless, like I said, unless I'm completely overlooking or blanking out on something. So.
And Chad, I don't want to.
This is Steve. I wanted to jump in here quick. That question was referring to salary, right? An owner's salary being capped. The owners are excluded from table 1 and table 2, so they're not part of the FTE calculations. That's part of the instructions on the application.
Thank you, Steve.
Thanks, Steve.
And another one for you, Chad, before you get muted. This is the last one that is in our queue here. It says, since software leases are so important to A&E First, can those be considered utilities?
Well, software leases, I think if you're going to claim them, are going to be under the rent, likely more than utilities. The utilities are a fairly prescribed category of items that you're allowed to take. Telephone, electricity, items like that. Software rentals are not, or software itself is not in the category for utilities. But I think your best bet maybe to look to try to get that included in the rental category, depending on what the nature of the arrangement with the provider is.
And Chad, correct me if I'm wrong, but I think we've had some internal debate on whether a software lease will even meet the definition for the rental payments, because I think we had some reading at some point that it had to be for real or tangible personal property, and there's some debate whether software would be considered an intangible and not meet that definition. I think that's a gray area.
Yes.
But that may be a difficult one to justify.
Yeah, I definitely think it's one that, I would suggest chatting with your lenders to see what their position of this is. Ultimately, they're going to be the first person to take a pass at this. It's not clearly defined in the guidance, but Tom, you're exactly on point. It talks about leasing of real or personal property. Would that personality extend to software? It's not clear. And even then, if it did, you really have to look at what it is that you're paying for every month, because it may not really all be, a lease. It may be some other types of charges. So I think that's one that's definitely to look out for, and I'd suggest chat with your lender absent further guidance.
Thanks, Chad. And Tom, we do have one or two that are not covered, but I will give you time to close this down and close this out. And this is just a reminder to everybody that's still on the line. These Q&As will be answered if they were not answered already in the questions panel and sent out to you via email. So Tom, do you want to close us down here this afternoon?
Sure. So again, thank you, Kaylee, and thank you all for your attendance once again this week. Thank you to our speakers and especially to Valentina for joining us this week. We really appreciate the insight that the outside experts bring to our panels here each and every week. You will be getting a survey after we complete. There will be some questions in there that we'd ask if you wouldn't mind answering those. Things about if you would like any additional information on any of the topics that we've covered, we'll certainly reach out to you and try to set up a call to provide that to you. And also, we're interested in what other topics you'd like to hear about as we move forward. So please join us again on June the 9th when we come back again for our next session. And with that, we're going to sign off for yet another week, but please stay in contact with us throughout, and we'll see you again soon. Thank you.